All right, everybody. It is 3:30 p.m. Central Time in beautiful Chicago. That means it's time for another OIC webinar event. My name is Mark Benzequin. Thank you for joining me today as we talk about the flip side of the coin. Last week we talked about long straddles and strangles, that is buying straddles and strangles to take advantage of a large move, either in the underlying stock or taking advantage of a large increase in implied volatility. Today we're going to be doing the flip side. We're going to be talking about selling straddles and strangles when we are not expecting a large move in the underlying, or if we're expecting periods of decreasing implied volatility. But before we get to that, for those of you just joining us, again, welcome. My name is Mark Benzequin. I am an instructor here at OIC. I am also a principal of OIC's Investor Education Program. I've been in the business for 25 years or so, and now specializing in creating content for OIC and OCC education. I'm very fortunate to be joined by two of my colleagues, Rolla Caldwell and Ken Keating, who are behind the scenes taking your Q&A live as they come in. So feel free to submit your questions via that Q&A portal on the left side of your screen. In addition, I want to invite you to download a copy of the slides via the resource list at the bottom of your console. This way you can, possibly take some notes as we go along in our presentation, but also something for you to refresh your understanding and review the material that we had talked about. So let's go ahead and get started with a little bit of our housekeeping. For those of you not familiar with OIC, we are a free and unbiased professional organization. We basically provide educational content as to the responsible trading and the risks and rewards of trading U.S. listed options. We do most of that through our website, optionseducation.org, where you'll find a host of online courses, podcast videos, and our OIC webinar program. For those of you that have questions, always feel free to reach out to our investor education team. You can reach us by email at options@theocc.com or chat with us live on our website, optionseducation.org. Our standard disclaimer here: options involve risks and may not be suitable for everybody. As a matter of fact, there is a document specifically geared and explaining those risks called the Characteristics and Risks of Standardized Options. If you're looking for a copy of that, you can download it on our website or reach out to your broker for a hard copy. So let's go ahead and get into today's presentation. For those of you that did join us last week, again, thank you for taking the time to join us again this week. And some of this information may look familiar. We talked about buying straddles and strangles last week. We're talking about selling straddles and strangles this week. So because it's really the opposite side to the same coin, a lot of the material that we're going to be covering today, at least in the very beginning, is really going to be a repeat of last week. So hopefully that will be a refresher for some of you. For those of you just joining us today for the first time, this will all be new. If you do have questions, again, make use of that Q&A function on the left side of your screen. One thing I wanted to address before we get into this is the survey responses from last week, which, by the way, I should certainly say thank you. You were very kind and generous in how you rated our event, so thank you for that. But there were a lot of individuals that had responded that this information was just completely over their head, and they really didn't grasp a lot of the concepts that we were talking about because they are new to the world of options. So last week's presentation, just like this week's presentation, are designed for intermediate level option users. So if you are a beginner, while some of this information may be confusing to you or may not be clear, if there is just one or two concepts that you come away with today that might make sense to you, or even so, some concepts that lead to a further discussion of questions that you might have. I guess what I'm getting at is I'm hoping that you still get something out of it, and please feel free to reach out to our team for further clarification. So let's go ahead and get back to our outline here. We're going to be talking about event trading, what it is, and kind of different examples of event trading, and then volatility plays. That's where the straddles come in. So today we're going to be talking about selling those straddles and strangles. We're going to be talking about strike selection and comparing the two different strategies before we get into what I hope to be an extended Q&A. So again, send those questions to us. Ken and Roma will be taking care of them real time behind the scenes, and I will be picking out some of them to share with everybody in the Q&A session at the end. So here we go, event trading and volatility plays. Event trading, as I explained last week, is trading designed for a specific event, hence the name. And that event could be an earnings release. It could be a drug trial result, a court ruling. I think I used an example last week of JetX, a fictitious airline, and we talked about a pilot strike or a baggage handler contract negotiation, something like that. So the idea is that you're looking to either capture profits or possibly even protect yourself against risk as a result of this event. And when it comes to these events, the outcome might cause share prices to either, as you can see here, significantly increase or decrease, or a shift in implied volatility, a sudden increase or decrease in the implied volatility of the option. Typically, when it comes to event trading, the trader has really no interest or no intent in seeing that option live to its expiration. Meaning, if I think that if I'm positioning myself to take advantage of a possible result of an earnings release or a Fed announcement, once that news, once that event is known, once the Fed comes out with, what they're going to do in terms of interest rates and what their forward statement is for the next quarter, for example, once that event happens, the trade typically gets closed out. So the event trader really doesn't have any interest in becoming long or short stock as a result of exercising assignment. Their idea, their intent is to simply get into the trade, hopefully position themselves to profit from whatever position they may have. And then once the unknown becomes known, which is a phrase that we use often when it comes to event trading, once the unknown becomes known, they simply close that trade and move on to their next investment. So volatility plays kind of go hand in hand with event trading because they are designed to potentially benefit from any changes in implied volatility. As we go into these events, right, that unknown event, we don't know what's going to happen with the stock price once earnings are released. We don't know how the market is going to react. So we may see a rise in implied volatility as investors compete with each other to position themselves for this event and position themselves using options. For those of you familiar with implied volatility, we know that as demand for any good or service, whether it's an option or an Apple or a Michael Jordan art autograph, for example, as demand for any good and service increases, so are the prices. And assuming that there's a stable supply of, in this case, option investors, assuming that supply doesn't really change, the increase in demand is going to push up option prices. It's also going to push up implied volatility. So people that are trading these event plays, they're looking to put themselves in a position where they can benefit from that run up in implied volatility, or on the flip side, benefit from what we call IV crush, implied volatility crush. Once that unknown becomes known, we often see the market kind of settle back down to where it was prior to that run up in demand. That's a concept called revert to the mean. And the idea is simply that everything kind of either rises up to the average or comes back down to the average. So in this case, once the unknown becomes known, it's not unheard of to see what we call implied volatility crush and those levels dropping back down. For the investor attempting one of these volatility plays, they're looking to profit from either scenario. When it comes to a seller, they're looking to profit from really either situation. If implied volatility levels increase, the option goes from being worth $1 to now worth $3. If I sold that option at $1, well, the increase in price to $3, that's not going to sit very well with me. But if I sell at that high end when that implied volatility is already inflated, which may be the case, then once that implied volatility reverts to the mean, once that unknown becomes known and those prices drop, now possibly I've got the ability to buy back that $3 option, which now might be trading in the market for $1. I sell it at $3, I buy it back for $1, and I pocket a $2 profit. So the idea with the implied volatility play, we're looking to capitalize on moves in implied volatility, but as they go hand in hand with event trading, we typically close that position out once that event occurs. So short straddles, we talked about this last week a little bit with the long options. Number of certainties in the market, right? There's only three things that the market can do. The market can go up, the market can go down, or the market can stay the same. Now, if we think the market is going to go up or the market is going to go down, then as we talked about last week, we might choose to buy a straddle or buy a strangle. Remember, those are two strategies that potentially profit from large moves in the underlying, either up or down, or they benefit from large increases in implied volatility. Again, the demand for options. So those looking to buy a straddle or a strangle, you may find that they get into a position early versus those that are looking to sell when implied volatility is already high. We can get in when the option's worth $1 and maybe get out when it's worth $3. A straddle or a strangle seller is kind of looking at things the opposite way. But the third point here, the market can stay the same. That's what we are going to be focusing on today. And the reason being is when you're buying an option, whether it's a straddle, a strangle, a regular call option, a debit spread of any kind, et cetera, you're looking for one of two things to happen, either implied volatility increasing or you're looking for market movement, right? And there's a number of reasons. If you're buying a call, then the cost of that call gets added to your strike price for your break-even point. So if I buy a $50 call for $2, I need the stock to be worth at least $52 by expiration, or implied volatility levels to increase in order for me to be profitable. So I need that stock to move in order to make any money. When it comes to selling, we don't need the stock to go anywhere. As a matter of fact, it might even be best for that stock to not move at all. Or if it does move, at least the stock moves minimally. It stays what we call range bound or stagnant. So if we're looking not necessarily for the market to go up or down, we're looking for the market to stay the same, what might we do? Remember, if we're bullish, we're going to be looking at strategies that take advantage of rising markets, increasing share prices. If we're bearish, we're looking for strategies that allow us to take advantage of falling markets. But if we don't think the market is going to go anywhere, or if we think that it's going to be trading within a very, very narrow range, what strategies are there for those investors with those forecasts? And that's where straddles and strangles, or I should specifically state short straddles and strangles, come into play. So you can see here the short straddle is a strategy whereby the investor can potentially benefit from limited movement in that stock, or also hand in hand decreasing in implied volatilities. The straddle, whether it's long or short, is made up of a call and put option of the same strike and the same expiration. With a short straddle, we're selling the call and we're selling the put at the same strike, same expiration. And the reason being, we don't really want that stock to go anywhere. So we typically use at-the-money strikes. If we've got stock trading $150, we don't want the stock to move much from that $150 range. We may, look for it to go 149, 151, something like that. But ideally, we want as limited movement as possible from that current share price. So we use at-the-money strikes. In this case, we would use a $150 call and put. We would be selling both of those options. And that's our short straddle. We would be short one XYZ $150 straddle for the month of January. Again, it's intended to benefit from these range-bound markets, falling implied volatility. We use the same strike in the same month. At-the-money strikes is typically what straddle sellers look for. Strangle sellers, something different, which we'll get into in a little bit. But other characteristics of this short straddle is that we've got unlimited loss to the upside and significant or substantial risk to the downside. And the reason being is because it combines a naked call, a short naked call, which, if you'll remember, has unlimited risk because we're obligating ourselves to sell stock at the strike price. And as there's no limit to how high share prices can go, if I'm selling a naked $50 call and stock goes to 500, well, I need to deliver those shares at $50, even though they're trading 500 in the open market. So I've got a lot of risk to the upside in terms of share price appreciation when I sell the naked call. So that's where we get the unlimited upside risk from with this short straddle. Now, on the downside, again, it's kind of similar to selling a naked put. The most you can lose is your strike price all the way down to zero. It's only limited by the fact that stock can't go below zero. So we've got potential loss, unlimited on the upside, substantial or significant on the downside. And if you notice this graphic here that I have, this flock of geese flying in the V formation, that is the shape of our short straddle. The right side, that's going to be our naked call. The left side, that's going to be our naked put. And if you could imagine that on a graph, as the stock price moves up or down, so does our risk. But aside from that, we've got our potential benefit, right? Like any selling strategy, the most we can make is the premium that we collect. So if we sell a straddle for $10, the most we can make on that straddle is $10. And then, like any other selling strategy as well, time decay, decreasing levels of implied volatility, those are things that are going to positively benefit. They're going to positively impact that position. And I want to digress for a second just to get back to the long straddle and strangle and how I had mentioned that you need stock price appreciation, or you need that stock price movement to see any profits in this. And the reason being is time decay, right? For those of you familiar with time decay, you remember that it's the concept that each and every day our option is going to be worth less and less. So as we approach expiration, and assuming that nothing else moved, an option that maybe we purchased for $1, it's going to be, day after day, week after week, it's going to have less value, 90 cents, then 50 cents, then 20 cents, et cetera, to where on expiration day, it's only going to be worth its intrinsic value. So when that contract expires, it's either going to be worth something, which is its intrinsic value, or it's going to be worth nothing because the contract expires at the money or out of the money and without value. The reason I bring that up is for option sellers, it's the exact opposite. That time decay is working in our favor. We don't really want the stock to move all that much because that $1 option that we sold today, it's now worth 90 cents simply from the passage of time. Next week, it might be worth a quarter simply from the passage of time. And if we sold it for $1 and we could buy it back for a quarter, simply by tearing pages off of the calendar, right? Time passes us by. That's what we're looking for. We're looking to profit from that time decay. And then again, we had talked earlier about decreasing levels of implied volatility. It also eats away or erodes the value of that contract. So that's what we're looking for with the short straddle and strangle. And let's go ahead and get to an example to potentially better illustrate this point. So here's one of our fictitious stocks that we like to use, Dollar. They're a make-believe home goods retailer. We've got an earnings announcement on the horizon next week. If earnings exceed or if they fail to meet expectations, prices are expected to move substantially, right? Wall Street typically comes out what they call the street's expectations of what earnings might be. If the company meets expectations, then we may not see a lot of stock price movement because it's basically already, as my old partner used to say, baked into the cake. It's already built into the pricing of those options. If earnings exceed expectations, or if they significantly mix, well, that's something unexpected, and the market would react accordingly, and possibly by seeing increasing levels of implied volatility, which, as we covered, that isn't good for the straddle seller. So if earnings are as expected, we're not expected to see a lot of movement in the stock. With stock trading currently $50 a share, here is a sample options chain. We've got the $50 call trading for $2.10, the put equally priced. And as we're not looking for a lot of market movement, we select to sell that $50 straddle by collecting $4.20 for the entire position. So here is a sample graph of what that straddle might look like. You can see by that red dot, that is going to be our strike price. And actually, I believe, let me get my laser pointer out here. That might help a little bit better. So here is the strike price. This is the $50 call and $50 put. As you can see, if there's not a lot of movement that's upward, this triangle here, this is all going to be profit. We generate the most profit, or I should say we return or retain the most profit when shares finish right at that strike price. That's where our max profit is, and that would be $4.20. Again, we're selling options. We can't make more than what we sold it for. So the maximum benefit or the maximum gain, maximum profit, whatever synonym you want to use, it's going to be limited to that premium received, $420. Our maximum risk, as we've spoken about already, that is going to be unlimited on the upside. That comes from this short call right here on the right, and it's going to be significant or substantial on the downside. That comes from our short put. Our break-even points, just like before with our straddle, we are going to add that premium that we paid to the call strike. So right here would theoretically be $54.20. We've got a $50 strike. We add $4.20 in premium. This is $54.20. And on the downside, we would subtract the premium from the strike, and this would be $45.80, which we'll see a little bit closer in detail on this next slide. So again, our $50 straddle trading for $4.20 from this short call, potentially unlimited risk from the short put, significant risks all the way down to 0. And we've got our break-even points. So if the shares finish between these break-even points, if they finish between 45.80 and 54.20, this is where you see our profit. So anywhere between these 2 points, again, that's that limited price movement. We're okay if the stock moves. We just don't want it to move too much. So if stock finishes between these break-even points, we're going to be profitable. If stock closes exactly at our strike price, if stock doesn't move at all, then that's where we achieve our maximum gain. We retain 100% of that premium that we collected up front. What might happen next? Let's see what might happen at expiration or in the interim. So we know that in order to benefit at expiration, either the long call or the long put must have a value less than $4.20, right? That's that break-even point. So it's either 45.80 on the downside and 54.20 on the upside. If shares finish outside of that range, then we'll start to experience losses, right? If either call or put is worth more than 4.20, we're going to give back not only all of the $4.20 that we collected at the time of trade inception, but we can be giving back a lot more than that. Again, unlimited on the upside, significant on the downside. Now, this is at expiration. So this graph represents our profit and loss at expiration. Now, prior to expiration, that's not saying that we can't have a favorable or a profitable trade. Again, if there's a change in implied volatility, if implied volatility when we get into the trade is, say, 75%, and then it drops down to 35%, again, maybe that unknown is now known, that earnings event has occurred, that decrease in implied volatility may allow us to profit on the trade as well, meaning that we don't have to wait until expiration because, again, with an event trade, we're typically not looking for expiration. We're going to close out that trade as soon as that event occurs. So what might happen next, and this speaks to the point that I was just getting at earlier, when we had got into the trade initially, I think implied volatility was 35%. So now let's say we're running up to the event or, I apologize, the implied volatility was 75%. So prior to the run-up of the event, we get into this position, implied volatility is trading 75%. Our straddle was $4.20. Now the unknown has become known. Now the earnings have been released. Now the drug trial results have been announced. Now the Fed made their decision on interest rates, what have you. Now we know what's going to happen. And now as a result of that unknown becoming known, implied volatility drops down to 35%. Now we did get a little bit of a share price movement. So we're assuming that the expectations were met. And we've got some share price movement from $50 to $52. That's okay. You know, we wanted to keep it within that range of $46 and change. I think it was $46.80 to $54.20. So we're within that range that we wanted to be. Implied volatility drops, so that helps us, as we know. And now that straddle that we sold for $4.20 is trading for just over $2. So at the lower level of implied volatility and at a higher stock price, and forgive me, this should say stock price and not strike price, or strike price, and this should be $50 and not $52. But that being said, now our straddle is trading around $2. So even at the higher stock prices and lower implied volatility levels, we've got a straddle worth about $2 that we had initially sold for $4 and change. So the question is, if we were to buy back to close this straddle, would it be beneficial? Would we have a profit? Well, of course we do. The answer is yes, right? We sold it for $4.20. It's worth $2 now, so we've got a gain of about $220 per straddle. So that's kind of how short straddles work. Remember, with a long straddle, we wanted the stock to make a big move by at least the amount of the straddle that we paid. When selling straddles, it's the opposite. We don't necessarily care if the stock is going to move, but we don't want it to move too much. When we're buying the straddle, we want it to make a big move. When we're selling the straddle, we either want no move at all or a move at least within the range that we chose when we decided to sell this option. And by choose, what I mean by that is simply the premium that we collected, because that's going to dictate those break-even points, and that's the range that we need to keep in between. So let's go and look at the, not necessarily a mirror image, but let's call it the cousin. The cousin to the short straddle is the short strangle. Short strangles typically use out-of-the-money options. Out-of-the-money options are cheaper than at-the-money options or in-the-money options. So the fact that we're collecting less premium up front, it means that we've got a lower amount of maximum profit, right? If we're selling these options for $1 a piece and we collect $2 on the strangle, well, that's going to be our maximum profit. Similar to the straddle, we benefit from range-bound markets, but those wider strikes, and let's get my laser back. So these wider strikes here afford us a higher probability to capture those maximum gains. If this is the at the money, right, this would be our straddle strike. We only achieve maximum profit if stock finishes right at this point. With the short strangle, we achieve maximum profit anywhere between these 2 points. Now, that maximum profit is going to be less, again, because we collected less up front, but it gives us a wider range for us to be right. Maybe that's an easy way to put it. We've got a wider range for our forecast to be accurate and for us to capture that maximum profit. But other than that, the mechanics are really the same. We're still sensitive to changes in implied volatility, days to expiration. Remember that implied volatility works the same. Decreases are good, increases are bad. Days to expiration, that time decay working in our favor, also a good thing when it comes to the short strangle. Now, let's use our previous example. Let's look at dollar again and assume that rather than selling that $50 straddle, we're going to look to sell a strangle instead. So we look at the out-of-the-money put, $45 strike put, trading for about 40 cents. The out-of-the-money $55 call, trading for about 50 cents. Now we're short the 45-55 strangle for 90 cents collectively. And here is what our trade looks like. Again, just like with the straddle, the short 105 call, think of it as a naked call. We've got unlimited risk, so we've got potentially unlimited upside losses. From the theoretically naked short 95 put, we've got significant risk to the downside, again, from our strike price all the way down to zero. And now that I look at this, ladies and gentlemen, I apologize, but all of these strikes are wrong. Yeah, I apologize. I'll have to correct that in post-production. So my apologies. It should be the $55 call and the $45 put. So again, I apologize for that. Mechanics, besides the numbers, the mechanics are correct. The investor might benefit before expiration, resulting from time decay, which we had talked about, or a significant decrease in implied volatility. Again, the idea is selling something at $3 and having the ability to buy it back for $1. Prior to, or I should say at expiration, we achieve our maximum profit. Again, as you can see, if shares finish between these two strikes, that's where we achieve our maximum. And the idea being is that both legs are going to expire out of the money or at the money even, but they're not going to have any value. They'll expire unassigned, and we keep 100% of that premium that we retain. Now let's go ahead and look at strike selection. Again, and a lot of this is similar to what we covered last week. Like any other strategy, selecting strikes for the short straddle and strangle, it's going to be a balance of risk tolerance, potential for success, et cetera. The idea with any option, regardless of strategy, and we covered this last week as well, is where is the forecast, right? Where do we think the stock is going to go, and how long is it going to take to get there? And let's address that second part first. How long is it going to take to get there? That's easy, right? We are doing an event trade. So we know that the Fed is making an announcement 6 weeks from today. Or we know that the company XYZ is doing their quarterly earnings release on, and I'm just picking out an arbitrary date, October 15th. So what we would do is we would model our trade to at least encompass that time period, right? If we've got an earnings release 6 weeks down the road, then it doesn't really make a lot of sense to sell a straddle or a strangle expiring 2 weeks from now, right? That's a full month before the event. So whatever we were attempting to capture, the run-up in implied volatility or a implied volatility crush, or if we were trying to capture market movement or no market movement, the idea is that all of that is irrelevant if our position is going to expire before that event has a chance to unfold. So when it comes to selecting an expiry, that's more easily addressed. Investor will typically look to encompass at least the time frame for that event to occur. Now, strike selection is going to be a little bit different. Short straddles typically use at-the-money strikes. Again, the idea is that we want to take advantage of a range-bound or stagnant market. We're not looking for a lot of price movement from where it's currently trading. Maybe we're looking for price consolidation, something like that. So with a short straddle, that's why investors typically use at-the-money strikes. With a short strangle, the out-of-the-money strikes, the idea is that it gives you, again, a wider range of success, a higher probability of success by choosing out-of-the-money strikes. The example, we looked at the 45-55 strangle. We achieve maximum profit if share prices finish anywhere between 45 and 55. With the straddle, we only achieve maximum profit if shares finish right at $50. But as I'm sure you know, when we go with out-of-the-money strikes, we're going to achieve less premium. Those options are valued less in the market. They're priced lower. So we're going to retain, or we're going to collect less premium up front, but we've got a higher probability of retaining that profit than we would with a straddle. So you can go as wide as you want with those strikes on the strangle, but obviously the further out of the money you go, the less premium that you're going to be collecting, and eventually it's going to get to a point where, well, sure, you're going to collect on this strategy, but you only collected 2 cents worth of premium. So it may not even be worth it to go that wide. So, again, it's going to be a balance of risk versus reward, risk tolerance for the investor, and then again, that probability of success or that potential to keep as much of that premium that we collected up front. So let's go ahead and compare the two now, short straddle versus short strangle. Maximum benefit, the maximum gains, maximum profit, again, all the same thing. Limited to the premium we receive, and that goes for both options. We're selling options, and again, I don't care if it's a short straddle, strangle, iron condor, butterfly, what have you, credit spread. We cannot make more than we collected at time of trade inception. Our maximum loss, again, similar to the naked options, substantial to unlimited, substantial or significant on the downside, unlimited on the upside. This comes from the short put. This comes from the short call. And then again, same thing with the strangle. Significant risk, to the downside and unlimited risk to the upside. Our break-even points, straddle, very easy to compute. We simply take our strike price, we add to it the premium that we collected. That is going to be our upper limit or our break-even on the upside. We subtract that premium from the strike price. That's going to be our break-even or lower limit on the downside. If shares finish within that range, within those break-even points, we're going to be profitable. If shares finish outside of those break-even points, that's where we're going to lose money. The strangle, slightly different. The upside break-even is simply calculated as your call strike plus the premium. The downside break-even is going to be the put strike minus the premium. Changes in implied volatility, we discussed this at length already today. An increase in implied volatility makes things more expensive. As a seller, that's not what we want. So any increase in implied volatility is going to negatively impact or have an unfavorable effect on our short straddle and strangle. If implied volatility levels decrease, that will most definitely benefit the seller here. And then again, time decay, we talked about that, positively impact. And actually, time decay, it's almost doubly beneficial because now we've got two options that we're selling. So rather than collecting, $2 for a single option and having time decay work on that, now maybe we're collecting $4 and time decay is working on each option. So definitely changes in time is going to positively impact that position. Key takeaways, and this is really just kind of summarizing what we've already talked about. Both short straddle and strangle potentially benefit from limited price movement. That's what we're looking for. Remember that range-bound share prices and also decreases in implied volatility. Both strategies limit the maximum gains to the premium received. Remember, we're selling options, so we can't profit or we can't make any more than we collected at time of trade inception. Unlimited risk on the upside, significant risk on the downside. That comes from that theoretically naked call that we sold and that naked put. Strangle investors has a wider probability of success, or I should say a wider probability of success in terms of retaining the maximum profit, retaining 100% of that profit. Remember our example, I keep 100% of that profit if shares finished anywhere between 45 and 55 versus had I sold the straddle, I would have only kept 100% of my profit if shares finished right at my strike price. And then lastly, both strategies benefit from the passage of time. That time decay is doubly impacting, in a positive way, doubly impacting our position. So before we get to Q&A, just a few items about the Options Industry Council. OCC Learning is our online platform that we offer. Right now, I believe we've got 8 courses. Long options, straddle strangles, long condors, long butterflies, etc. Was released not too long ago. That's course number 8. We just talked about long straddles and strangles in last week's presentation. So for a deeper dive, be sure to visit our website, optionseducation.org, and look for that buying strategies course. We're putting the finishing touches on our selling strategies course. We hope to have that launched within the next couple of weeks or so. And we talk about short straddles, short strangles, iron condors, iron butterflies, etc. Also on our website, you can download our podcasts and videos, and then we have live options help from our investor education team. And here's our contact information. Optionseducation.org is our website. Options@theocc.com is our email address. So please feel free to reach out to us with any questions that you may have. And please follow us with social media so you can stay on top of any upcoming events that we've got on the way. So let's go ahead and take some Q&A. Let's see what we've got. Here we are. What is considered high volatility and low volatility? Excellent question. Unfortunately, it doesn't necessarily have an easy answer. What is high for some may not be for others. So it kind of depends a little bit about what an investor thinks, what their risk tolerance is. Implied volatility, or just volatility in general, for those of you that aren't familiar with, it describes the potential for share price movement in the future. Implied volatility, that potential for share price movement is reflected in the price of the option. And look at it from a seller's standpoint. If I'm selling an option, I incur risk. If I'm selling a call option, I'm obligating myself to, in a sense, sell my stock at my strike price between now and when that contract expires. If I don't know where stock is going to be by the time that contract expires, then I've got a tremendous amount of risk, right? If I don't know where stock is going to be a month from now, it's going to be hard for me to commit to selling stock at $50 a share if I don't know how the likelihood of stock staying around $50 a share for the next 4 weeks. So the idea as a seller is that because I don't know where stock is going to be, I've got increased risk. To compensate myself for that risk, I'm going to raise the offer on the option that I'm willing to sell. So if somebody wants to buy that option from me, they're going to need to pay me more money. As those prices increase, so does implied volatility. Now, back to the question of what is considered high and low, it really depends on the underlying security. There are some stocks out there that are, have big swings in the market. Think about, not too long ago, we had all of those meme stocks. Some of those securities that we saw, double-digit swings in prices from, one day to the next, versus look at, I apologize. I think I need to turn off my screen share. There we go. Sorry about that, everybody. Let me turn it back on because I don't think you're seeing that screen. There we go. Okay, sorry about that. So there are some high-flying stocks where there's a big range of prices that you may see from day to day. Now, that doesn't necessarily mean that it's got high implied volatility. The stock itself may have significant volatility, but in terms of the option, the implied volatility is what the market is expecting to happen in the future. So if you've got an implied volatility of, say, 200, is that high? Well, somebody may think yes, but if the stock is, or if those options are always at a 200 vol, it may not necessarily be high, a high level. But when we talk about implied volatility, what we're really talking about is the cost of the option. We're saying, is that option expensive or is it cheap? So leading into earnings, you may have an option that's worth $1. As the demand pushes the value of that up to $5, you would likely see a significant increase in implied volatility. So implied volatility is kind of relative in the sense that for those that are looking to get into to buy a strangle or a straddle, they may look to get into it early before those prices get run up. For a seller, they may look to sell that option when prices are already at an elevated level. Again, the idea that you want to sell something at $5 and then look at buying it back when it's trading $1. So high volatility versus low volatility really all depends on the stock and what the expected move may be. If it's always expected to make big swings, you're always going to see that a higher number. But when we're talking about straddles and strangles, we're really talking about capturing those changes in implied volatility. And typically after that event occurs, you'll see implied volatility go from, say, a 75 vol to maybe a 35 vol. And the option price would drop accordingly. That's what we call IV crush and that's something that implied, or I should say, investors in short straddles and strangles are looking for. Let's see, another question that we've got. What is the best way to manage a short straddle trade when either the call or put become in the money? Best way to manage? I have no idea. The reason I say that is because I don't know what's best for you. I don't know your risk tolerance. I don't know your experience. But aside from that, we don't make recommendations and we don't provide investment advice because we're not advisors. So I would answer the question this way. First and foremost, remember that these trades are designed on a specific event. So if something happens to now that call is deep in the money or now that put is deep in the money, if that happens as a result of the event, typically the investor would just take their lumps, right? They didn't think the stock was going to move very much and it did. They simply close out that trade and take their losses. Or what they may do is if the call is deep in the money now, and if you close out the put side, because, the put side now would have no value. One of those legs is going to have value and the other won't. Close out that put, and now what you're left with is a short call. To manage that, you might, with a short call, now you're in a aggressively bearish outlook, an aggressively bearish position. If that's not your forecast for the stock, then you would either maybe roll that into a bull call spread somehow, or you might roll that into a butterfly, something like that. You might add more to it, or you would simply just close out the position and realize that, hey, I was wrong on this, and now I'm going to go ahead and look at something else and try and recoup some of those losses. Let's see some other questions that we might have here. Can you please talk about how adding legs to a short straddle or strangle turn it into a condor or a butterfly? That is a complex question, something that I don't think without visuals I'm able to get to without confusing everybody, and actually without even confusing myself. So Mitchell, I'm afraid we're going to have to answer that one in writing. I apologize with that. Let's see, here's another question. Implied volatility crush, IV crush, is that something that always happens? And if so, why doesn't everybody just sell straddles all day long? Anytime the word always is used, the answer is no. Just like the flip side, anytime the question or the word never is used, the answer is no. So does IV crush happen all the time? No, it absolutely doesn't. It does happen, often, I guess is, something that we can say. And that's what these short straddle and strangle investors are looking to capture. But think about this. Let's say the company comes out with earnings, and whether they were positive or negative, implied volatility, theoretically you would expect to go back down. But the company, in addition to their earnings, they also make what they call a forward statement, what they think is what the outlook, what their outlook is for the next quarter. So if the company's outlook for the next quarter is something significant, maybe they're saying that, hey, this quarter was good, we met expectations. Next quarter is going to be great because we're releasing some new product line. We've got some more drugs that are about to hit the market, or something like that. That you may have that inflated level of implied volatility may now become the new norm. So maybe implied volatility was 35%, leading up to the event. The day of or the day before earnings release, implied volatility 75%, let's say. And now, based on what the company is telling us, now there's even more uncertainty for the next quarter of the price of the stock going up or down, depending on how successful this new product is or what have you. And now maybe volatility doesn't go back down to 35. Maybe it goes to 60 or 70. Maybe that's now the new norm for the quarter. So to answer the question, no, implied volatility crush doesn't always occur. But I'm glad for the question because it brings up something that I mentioned last week and I forgot to mention this week. And that is other uses of a straddle or strangle, for example. Remember last week we talked about that investors might use a straddle to gauge what the market's expectation is for the stock price movement once that earnings announcement is made, or once the drug trial results are known. So the reason I bring that up is by pricing the straddle, the at-the-money straddle, for the expiration, the nearest term expiration to when that event occurs. By pricing that straddle, it tells you what the market is expecting that move to be. So you take the price of the straddle, you divide it by the current stock price, that gives you a percentage. So for ease of numbers, let's say we've got a $100 stock and both call and put are trading about $5. So the straddle is trading $10, 10% of the stock price. So the market, the street is forecasting a 10% move in the underlying. If you think that 10% is, what's the word I'm looking for? If you think that 10% is on the low side, if you're forecasting more of a 15% move, then you might be a straddle buyer or a strangle buyer. If you think that 10% is overhyped, then you might be a straddle seller or a strangle seller. In addition to that, and again, this is something I talked about last week. In addition to that is not only you can look at what the expectations are for this particular quarter's earnings release, but you can look to see what last quarter's expectations were and how the market actually performed. You can look at the earnings release for the quarter before that, and the quarter before that, et cetera. What I'm getting at is you can look at a historical perspective. You can take a historical snapshot of what the market expectations were and also how the stock performed after that unknown became known. And you can use that to help inform your opinion of how the market is pricing this current earnings release. So the idea is using information that almost back testing, if you will, using information that's already there to see what happened to help gauge what might happen in the future. Obviously, that's not always the case. We never know what is going to happen from quarter to quarter in terms of market events, but it's just another use of a straddle, whether it be long or short, that I wanted to get across. And again, thanks for that question about implied volatility crush, because it kind of jogged my memory to include that. Now let's go. It looks like we've got a couple minutes left, so let's take another question. Let's see, managing that. We already talked about that. Implied volatility, the relationship between a long condor and a long strangle. A long condor is made up of a long call spread. Well, if we're talking a call condor, put condor, or a long iron condor, there are three different ones. Iron condors are typically what people trade the most. So if we're looking at a long, or I should say, a regular iron condor by definition is a short position. You're selling a call spread, you're selling a put spread, and again, you're looking for that limited price movement. So your short call and your short put, think about that would be the short strangle that we talked about. And then in addition to that, you're buying a long strangle with strike prices outside of the strike prices of your short strangle as protection. So those long options our protection should you basically prove wrong. So you can turn a short strangle into a short iron condor simply by buying a further out of the money call for protection should things go wrong to the upside, and buying a further out of the money put should things go wrong on the downside as protection. One of the differences of the two is, you're giving back some of the money. If you sold the strangle for $5, but now you're buying for protection a strangle for $3, well, now your maximum profit for that iron condor is going to be $2. So while the two kind of work the same in terms of that, range of probability for success, again, that's going to be the difference between those two short strikes. With the short iron condor, you've got some protection should you go wrong, but you are paying for that protection, so that's going to reduce your maximum profit. And similar to that, you can look at the strangle. You can turn that short strangle into a short iron butterfly, again, by buying that out of the money strangle for protection should you go wrong. But similarly, by buying those options, that's going to reduce your overall profit. It's not going to do anything to increase your probability of success. The only thing that it does is it provides some downside protection and upside protection, for that matter, should things go south on you. So that's about the time that we have, ladies and gentlemen. Again, thank you for such great questions. Ken and Roma, thank you so much for handling the Q&A during this presentation. For those of you that didn't have your question responded to directly, either from Ken or Roma or myself during this session, please keep an eye in your inbox. We will be responding to you within the next likely 24 hours or less. So any unanswered questions, we will get back to you with an answer